Just hurt my back this morning after a childhood pursuit of cricket and football that lacked the talent and the physique for it, so paying the price now. So I just thought I'll kick off. I'll be talking about property, how it can relate to the SMSF, and also how different availabilities or different ways you can invest in property as opposed to just mortgaging up and buying in another rental property. The usual disclaimer, so obviously I'm not providing anyone here any advice, it's general in nature. About myself, apart from being an invalid at the moment, been working in property or financial services since I graduated university, which is 22 years ago now. I think I got my 25-year school reunion on Saturday, so that's about right. And then we'll move straight on to property. So it is the largest asset class in the world, and certainly there's no doubt that there's almost an unhealthy obsession with property or residential property as an asset class with Australians, and their love affair with property, and in some cases acquiring as much of it as possible. Specifically residential property, certainly thanks to a few spruikers out there that run the Get Rich Quick seminars, there's plenty of people out there willing to leverage themselves with the eyeballs to gain as much property as possible. It can be a growth asset and a defensive asset, which certainly makes it a strong option for your SMSF. And given that popularity of property, it's unsurprising that many Australians are now looking for ways to combine the SMSF, sometimes with disastrous results and sometimes with good results. But certainly it's far too common in the last sort of 20 years for people to establish an SMSF purely for the sole purpose of acquiring a single property. And obviously that comes with many issues, not least diversification. Having said that, buying investment property is not the worst thing in the world. I own a couple, but it's certainly a unique qualification or expertise of mine over my career. And certainly, covering some of the downsides that you can get after acquiring a residential property. Obviously, requiring 10% deposit, new mortgage, tenants, heavy reliance on linear growth. It can actually affect your borrowing capacity outside your superannuation environment. And Darren's just added another one. You can get taxed on unrealised gains now as well. So if your property value is going up inside your super fund, you might get a nasty surprise. So I might have to add that to my bullet points next time. Hopefully not. Hopefully it doesn't get through. So buying an investment property also within the SMSF environment as opposed to outside. Obviously the limited recourse loans have dried up, high rates, lack of diversification, and as I also said, reducing your serviceability outside super. So normally, as Darren pointed out, I follow Lauren. So I'm talking about investing in property as opposed to buying an investment property. So it's obviously got lower capital requirements. You do have that ability to diversify. There's no requirement to take on any debt. It's a very passive involvement, and you do have both liquid and illiquid opportunities. You can invest in commercial property, retail property, industrial property, as well as the traditional residential property asset. There is listed and unlisted REITs. You can invest in land syndication, managed funds, and where we fit in, unlisted management investment schemes. There's many operators, as what Lauren offers with her think tank. There's Latrobe, there's Trilogy, there's Qualitas, who have like a pooled mortgage scheme, CFMG Capital. Interestingly, we didn't set up our business like this, but 85% of our investors are actually SMSF trustees. So while we didn't design it that way, it's turned out that that's our target market almost by accident. And I think it's not a surprise because it's for young to middle-aged Australians, it's your biggest source of investable cash. Certainly there are different mortgage type funds. We're dealing with rating agencies on the moment on a couple of our products, and To my surprise, they much prefer a pooled scheme as opposed to a contributory scheme. Very broad brush definition there is a pooled scheme. We might just market a fund that has a big bucket of money, and then you invest, and then we get to choose what assets we buy and where we invest it, which in my mind I would think is, a lesser option, particularly for a rating agency. Putting your hands putting your funds in the hands of an investment fund that doesn't have to tell you what they're doing or doesn't have to answer to you. Whereas a contributory scheme, they might list a fund, they'll tell you exactly what assets are in it, or it could be a single asset, and you know what you're going into, which is what we offer with one of our funds. So investing in property with CF&G Capital, apart from, there are a number of operators in this space, but I guess our point of difference is we don't loan to third parties. So, using Balmain as an example, or a Holden Capital, they'll identify a developer, or a developer will come to them seeking a loan. They'll then raise the capital, lend to the developer, but they, as an operator or a fund, don't have any skin in that game. They're just the middleman. Our difference is we are the developer as well. So we've identified the asset. In most cases, we've either already settled the asset or have an unconditional contract and a large deposit paid. We're running the actual development, so we have two key sides to our business, both our funds management, which I'm talking about today, but we're also a traditional residential developer. So we buy, develop, run the contractors, run the tenders, sell the blocks, and finish the completed estates. As a result, in my view, of course, I'm somewhat biased, of course, but our level of due diligence on an asset versus a normal fund manager's level of due diligence is going to be significantly higher. We've considered that asset. We've done detailed assessment. We don't just get the money and lend it out to someone else. We earn a fee, but we're not just a fee earner. We're aimed at generating profit from that estate or that project, and then after investors are paid back, we'll take those profits. So fee earning for us is a secondary part of our business, and in fact, if you take the time to read the PDS, we waive our fees until investors are paid back. So our land and opportunity, we have two funds. Our land and opportunity fund, which is where we create value through development. So we're not, obviously the property market through the COVID period and into late last year was about as hot as I've ever seen it in my career. And that's, not going to lie, that's good for us. But we operate through various market cycles. We're not reliant on a growth market. We create value by taking an asset and improving it either through development or through an approval. Our first mortgage income fund is a slightly different beast. It's got a lower return and it obviously by its very nature pays an income, so a quarterly distribution, and it's not used to fund any development. So what we do with that is we might use it to fund or secure the funds against what we call residual stock. As I said, the market's been pretty hot the last 3 or 4 years, so there's no real such thing as residual stock at the moment. But we might use it to acquire a potential development site. So I think I'll go into that in the next couple of slides, so I won't get too far. So moving on to Land Opportunity Fund. We've done somewhat, I think 39 developments now. We've completed those 39 successfully and returned 100% of capital and met the targeted return 100% of the time. When we're considering opportunities via the Land Opportunity Fund, talking about that value and how we create value without that growth, is we ask ourselves a key question: does the opportunity provide an appropriate forecast return at or above our target if land values at today's rate remain as they are? Now, if we get an answer of yes to that question, that's when we start detailed analysis. If it's a no to that question, we throw it in the bin and we move on to the next one. Having said that, only about 20% of the yeses still make it into the Land Opportunity Fund because there's so many other factors to consider when you're taking on a development. We'll stress test our land values, so what does the return look like if the property values go up? Obviously, usually better. Having said that, with revenue growth usually comes cost growth. What does the feasibility look like if land values go down? And in the opposite effect, if we get cost growth while land values are going down, it has to pass these stress tests. We do infrastructure assessment. Do we have sewer lines going past the front door? If we don't and we have to build 2 kilometres of sewer, is it creditable by council? Can we get an infrastructure agreement with council to make sure that's going to happen? Because certainly in my time in development, there's been plenty of times when council have said they'll credit you, and then when you put your hand out for the credits, if you haven't got your infrastructure agreement ironclad, those credits don't come. What's the competitor activity in the area? Engineering analysis, flood mapping. There's so many environmental considerations to consider. Certainly in Queensland now, the state government's put koala mapping across properties all over southeast Queensland, including properties covered in pine trees. So can you get the koala mapping removed, considering koalas don't live in pine trees? And often the answer is no. So you have to consider all these things. Moving on to the First Mortgage and Income Fund. The example I was going into earlier is, and what we're primarily using it for at the moment, is if we're developing a site and we identify that the neighbouring parcel is prime for development but doesn't have the appropriate zoning or doesn't have the appropriate approval, what we'll do is, if we need to secure that asset to get it off the market because other developers are circling, we'll purchase the asset through our First Mortgage and Income Fund as is where is valuation. So assuming no approval, no development, we'll borrow up to about 70% of its LVR to fund our cash flow while we're getting the approval. Usually we'll, in every case other than one in our time operating this fund, we've then gained that approval, and with an approval comes a significant valuation uplift. Once that's completed, we would then shift the asset into our into our Land and Opportunity Fund. The valuation's obviously gone up significantly, so that creates skin in the game and significant equity for us, and investors are paid out. We have had one where we weren't able to buy or able to get an approval, but because we only borrowed 70% of its value, we weren't able to get the approval. We were able to just sell the asset pretty much for what we paid for it. In fact, we got a 13% uplift, and investors are still able to be paid out because the valuation's done as is, not with approval or potential approval. So who we are? We've got an independent board. Our chairman was the founder of Cromwell Property, and most of you will be familiar with Cromwell Property, market cap of about $3 billion. And we have over about 1,000 active investors. We've raised, deployed and returned in excess of $100 million to investors, and we have a reinvestment rate of over 90%. Our minimum investment's only $25,000. We hold a retail AFSL, so we don't have the limitation on requiring you to be sophisticated. And majority of our investors, we do have quite a number of sophisticated investors, but we only know that by the amount they invest, really. The average first investment is about $39,000. The average investment is about $79,000. That's based off people usually like to dip their toe in the water first time around. And our biggest source of new clients is actually referrals from existing clients. We have undergone change in the business in the last 6 or 7 years. So we've started in 2008. We spent the first period of our existence, we ran a fixed return model in our Land Opportunity Fund of 12%. We've now reduced that, and it varies by the length of the project, how long it's going to take, how much capital we raise, what its status is on an approval. The main reason we paid that fixed 12 was to build a track record. And once you've built that track record, certainly when rates were 1%, we didn't need to be 11% over the odds. So The reason I say that is that's our most recent completed investments in the last 5 years, and don't want people to come to my booth looking for those 12% offers because they're not there anymore. And you'll see that one that's snuck in there in the middle, which was our most recently completed one where we started paying a slightly lower rate. There's two reasons for that. Is one, to be more competitive, and two, when that question before about making a project work, if you have to pay investors 12%, it takes a lot of potential opportunities out of the market. Because we want an appropriate margin above that, both for risk for our investors. So if a feasibility shows 13 and we're going to pay investors 12, it's not worth doing. But if we're paying 10 and feasibility shows 16, there's a bit of a margin there, or a risk margin for us in case something goes wrong. Our first mortgage income fund only started in 2020, so much shorter lifespan. And those projects are only, they're not projects, those funds are only usually 6 to 12 months while we seek an approval. And those returns are commensurate with the risk, given it's a first mortgage product and the period that you're invested in. So that concludes my presentation. If you've got any questions, I should have said you can ask questions during it. Given I can barely stand up, I won't be at my booth for too long, so if you do have questions in person, I might hang around for about an hour, but otherwise I welcome some questions now. Yep.
On average, how many out of all the deals you're looking at the moment, on average, how many stack up?
Less than 10%. We haven't done a project in New South Wales since 2014, so 0% in New South Wales. And I can't see us doing one unless it's like what I would call Gold Coast, but it's just over the border. We've looked at Wollongong, Sydney and Newcastle, but people are just paying a little bit too much for sites, more than we're prepared to do. We're about 80% weighted to southeast Queensland at the moment. That's not because our business is based there, that's because where we see the market being strongest. We are active in Melbourne as well on 2 projects, with another project under contract, but probably 3 years away from construction. We had a blip in Melbourne because we like to eyeball sites. We couldn't go there for 2 years, so we're a little bit behind in that regard, because if we can't go and walk the site and look at it and assess it, we won't buy it, and we couldn't get into the state for 2 years, so that slowed us down there. No further questions?
I've got
oh, yep.
There's been a lot of recent issues with big building firms going under and the like because of the way they're geared and everything else. Do you see that as an opportunity, obviously, for yourselves, or do you see that as something that can potentially continue to go down?
Yeah, it doesn't directly affect us in the sense that we don't do any built form, so what we're doing is roads, infrastructure, but it indirectly affects us because of confidence. So if someone's buying a vacant block of land from us, obviously they're going to have to build a house. So if they've got no confidence in the house building process, they're less likely to buy a block of land, and we've certainly seen that. Traditionally, you might sell what we're off-plan selling effectively. You'll be able to sell 12 to 18 months out. These days, most buyers, particularly owner-occupiers, they don't want to touch it until they've seen the roads and they've got some certainty about when they're going to start building. There's still obviously, if they do their research correctly, there's still plenty of builders that are very safe, but the average Joe doesn't know how to check the liquidity of your builder. We try and help and guide that process by partnering up and packaging them up with builders that we know to be very liquid. The other indirect impact on that comes with our financing of our projects. So a bit of a chicken and egg scenario. Banks want to do a drawdown on your construction facility when they've got a certain level of pre-sales. People don't want to buy the block of land until you've started your construction. So the bank wants you to start to get pre-sales, and the buyers want construction to start, so they buy a block of land. So you're kind of caught behind a rock and a hard place, but we've been able to fund our construction or do deals with our civil contractors to commence construction early, and then the pre-sales usually flow pretty quick. and that's by good relationships and a good track record over 15 years.
So are the pre-sales drying up at the moment?
Early pre-sales are harder to get unless you, as put it bluntly, unless you've got big toy Tonka trucks on site. People are very unlikely to buy a block of land if you've got a paddock with a sign in it. You need the roads sort of be to starting to form, or some big yellow trucks driving around. People get some confidence. If you don't have that, they're far less likely to purchase something. Investors will, but they'll want not so much a discount, but they'll certainly want to feel like they're getting a good deal by committing that far out. Particularly because they won't be able to lock in their builder's price. They'll commit to a house and land package that's, say, 300 grand for the block of land and 300 grand for the house, knowing full well by the time they build it could be 350 for the house. Although, in my experience in the last 6 months, building prices are stabilising and coming backwards. Not really due to material costs. Material costs were driving the price increase and plus supply chain issues, whereas prices are coming back now because the trades have actually got to get real a little bit because the market's not as hot as it was, so they can't just basically have a painting going and say, I'm not going to paint those 10 houses you built for the price I told you 6 weeks ago. I'm increasing my price by 30%, I'm not painting them. They can't do that. They can't extract the urine, as I'd say, which is what they were doing for a period of time.
Yeah.
That's it. Okay, thank you.
There are two ways to invest in property. The hard way is to buy a property and wait, maybe for years, hoping it improves in value. The other way is through active investment in development projects, where approvals and subdivision potentially add value to the property. You may think that this kind of investment takes funds and expertise, but that's where CFMG comes in, with our Land and Opportunity Fund. We give you the opportunity to invest in significant development projects with as little as $25,000 using our specific investment criteria. This opportunity also provides diversification across multiple projects. By pooling your funds with those of like-minded investors, you can invest in development projects that are typically out of reach to everyday investors. When you invest, you're investing in the transformation from one large parcel of land into smaller subdivided residential lots. While our analysts assess and investigate many projects per year, only a select few meet the specific CFMG criteria. Here's how it works. Once you've registered your interest with us, we'll contact you when a project investment opportunity becomes available. We'll send you detailed information in the form of a product disclosure statement, including the project criteria, risks, and returns. If you decide to go ahead, your funds go into a pool used to purchase the land and complete the project. Our experienced team then manages the project through construction, subdivision, and sales, keeping you up to date throughout the entire process. If the project is completed successfully, then you get your initial investment back, plus any profits calculated using a fixed percentage return each year. You can repeat this process as often as you like, reinvesting your initial investment plus any returns into the next project. The CFMG Land and Opportunity Fund is open to all investors. It's a property investment with no agents, no maintenance, and no unpaid rent. You just sit back and relax while the experienced experts run the development for you. Our business holds an Australian Financial Services licence, so you can be confident that your investment is professionally managed in a regulated environment. So why not give us a call and see how even a small investment can produce returns for you?